Are you aware that the federal government can reclaim a massive portion of your recent silver and gold profits right now? Today, we will break down the exact IRS collectible rules that could shrink your net take-home position this year. Protecting liquid capital starts with real math. How precious metal taxes affect your net position, cash reserve, timing, and your long-term plan or retirement runway after taxes clear. The IRS classifies many forms of physical silver and gold as collectibles, which can push long-term federal tax on gains up to 28% on sales for top brackets. Recent policy moves, including adding silver to the federal critical minerals list, may increase scrutiny and volatility, but those labels do not rewrite tax law in Washington or markets. You might assume your metal gains follow standard long-term capital gains rules used for stocks, capped at 20% federally, and you would be wrong. That single assumption can manufacture a surprise bill that erodes liquidity, distorts planning, forces defensive sales, triggers penalties when you least expect it. If you are within 10 years of your life, goals timeline, or your retirement timeline, a surprise tax reserve matters more than the headline price. Because timing risk becomes the enemy of compounding, and calendars do not care. Selling without a plan creates reporting trails through brokers, dealers, payment rails, and bank statements. Plus Forms 1099, and everything must reconcile cleanly for your CPA. When your numbers do not tie, your net position collapses after tax, and the rebuild happens with fewer paychecks, less margin, less optionality, before banks notice. That is why this is not about metal fandom. It is about Schedule D math, cost basis proof, and protecting your financial goals or retirement distribution schedule from forced selling during downturns. Silver has recently traded above $80 per ounce, and gold has printed record highs above $4,000 per ounce, expanding taxable gains quickly in early 2026. Price strength creates confidence, but it also makes a larger taxable gain, and your required tax reserve grows in the same direction, at the same time, every time. Can you truly afford to lose nearly 1/3 of your long-term plan or retirement growth to avoidable taxes, plus fees, plus timing losses, during this economic period when the bill arrives suddenly? Holding over 1 year makes a gain long-term, but the collectible label comes from the asset type, so that the higher ceiling can follow you across taxable accounts, ETFs, and trusts. Here is the second hit. The collectible rate makes your required tax reserve so large that one sale can freeze liquidity, tighten credit, spike utilization, and break a HELOC plan. Exchange-traded funds backed by physical metals are also treated as collectibles, so you do not automatically escape the collectible ceiling by buying an ETF. If you use futures-based funds instead, you may face the 60-40 rule under Section 1256, which creates a different tax profile. That 60-40 split blends long-term and short-term treatment, and the effective top rate can still feel punishing versus standard equity gains. Tariff proposals and trade tensions with key trading partners can contribute to supply shocks, and critical mineral politics can amplify headlines and volatility. Those policy headlines do not change the collectible rule, but they can change your behavior, your timing, and your decision to sell at precisely the wrong moment. If you are managing a substantial paycheck and a real portfolio, you must navigate thresholds and policy noise to protect your lifestyle stability and achieve your objectives, or secure your retirement through this transition. Net investment income tax may add another 3.8% in some cases, so that total federal exposure can exceed 31%. State-level taxes can further complicate the math, which means your actual net gain can be meaningfully lower than the market move. Strategic wealth protection requires understanding these thresholds versus your private assets, because your plan is measured in net, not in headlines. Higher taxation reduces liquidity, and lower liquidity reduces your ability to reallocate quickly when markets break or opportunities arise. That liquidity trap becomes a secondary crisis because it blocks the agile movement of capital into more tax-efficient vehicles when you need flexibility most for your financial goals or retirement. Inflation can erode the purchasing power of what remains, meaning a tax hit is not only a percentage hit, it is a lifestyle hit. Some tariff proposals affecting mineral supply chains could push prices higher, but they can also raise industrial costs and increase volatility. Industrial demand for silver and solar panels and electric vehicles remains elevated, and supply constraints can create sharp swings that test discipline. Volatility forces bad timing decisions, and bad timing decisions create taxable events during periods when you have less margin for error. Government policy may use revenue and incentives to fund domestic mineral production, but your personal net position still absorbs the tax friction. Compliance costs for reporting complex precious metal transactions can rise, and you may need specialized tax help to avoid expensive mistakes. Detailed record keeping is non-negotiable because missing cost-basis documentation can create worst-case outcomes when the burden of proof is on you. If you report significant gains, you should assume higher scrutiny risk, which means your documentation must be strong enough to answer questions quickly. This chain reaction of tax, volatility, and audit risk threatens the stability of your wealth protection strategy if you treat metals like simple stocks. If you are 55 to 64, you are vulnerable because you are shifting from accumulation to distribution, and distribution timing magnifies errors against your long-term plan or your retirement. Withdrawing funds for your financial goals or your retirement during a period of high taxation shortens the duration of your liquid capital, even if markets look strong. If you rely on metals as a hedge, the tax bite can partially nullify the hedge at the moment you actually need to spend for your objectives or your retirement. Selling silver to cover medical costs or living expenses triggers high rates, and your emergency reserve can vanish faster than you planned. Exposure to the collectible ceiling is a direct threat to longevity when it forces liquidation at a bad time against your life goals or your retirement timeline. You must balance liquidity needs against tax drag, or you risk outliving assets while believing you are up on paper. Wealth erosion happens silently through the interaction of federal rules versus your net position in these specific commodities. Sunset clauses in other parts of the tax code can tighten overall household cash flow, which makes your margin for tax surprises thinner. Many advisors default to stock logic, which can cause them to overlook the unique tax status of physical metals and metal-backed ETFs. That oversight creates a direct conflict with your plan by creating an unexpected funding gap at the distribution stage for your financial goals or retirement. Protecting your net wealth requires proactive adjustment of your tax posture before you reach 65, not after a surprise bill. The intersection of trade policy, industrial policy, and internal revenue rules creates a higher risk environment for anyone seeking capital security. Failure to act can lock in permanent wealth loss that took decades to build, because the last working years have less time to recover. Consider selling $100,000 of silver bullion and expecting to keep $80,000 after basic taxes. Under the collectible ceiling, you could owe as much as 28% federally on the gain before any additional layers apply. Adding the net investment income tax in applicable cases increases the loss, and the capital available for reinvestment shrinks further. Consider a gold exchange-traded fund that doubled, and you sell because you assume a 20% long-term rate. If that fund is treated as a collectible because of the underlying asset, the ceiling can rise to 28% federally. That 8% gap is not trivial because it can represent years of financial goals or retirement spending you just transferred to the government. If you use silver futures, you might face the 60-40 treatment, and the effective top rate can still be extremely high. A hypothetical loss of $15,000 in excess tax is a measurable reduction in future purchasing power, not an abstract concept. These examples show that the math of precious metals differs from that of stocks, so your expectations must change before you sell. You can reduce exposure by treating documentation as a first-class asset, not an afterthought you fix during tax season. Maintain immaculate records for every purchase, including the date, price, dealer, storage method, and any fees associated with the acquisition. Reconcile your precious metal activity monthly so you understand your realized gains risk before you trigger a sale. Use cost-basis tracking tools so you can produce clean numbers quickly when your preparer asks and when the IRS questions. Consider whether holding certain metals in a self-directed retirement account fits your risk tolerance because tax deferral can change the outcomes of your long-term plan or retirement. Rebalance inside tax-advantaged accounts where possible, because moving inside the right wrapper can reduce your taxable drag. Monitor policy signals such as updates on critical minerals for market context, but do not confuse policy headlines with tax rule changes. Evaluate your net position quarterly against your tax thresholds, so you can anticipate reserve needs before the sale is executed. If you prefer equity exposure, mining stocks can be treated as long-term capital gains, but they add company and market-specific risks, That structural shift can reduce collectible exposure but replace it with operational risk, management risk, and equity drawdown risk. Adequate wealth protection requires vigilance because the goal is net position stability, not headline returns. First, audit your silver and gold inventory and capture the exact purchase date and price for each lot. Second, run a tax reserve scenario using current market prices, including stress cases where silver trades around $80 per ounce. Third, identify which lots have been held for more than 1 year because that sets long-term treatment, while the collectible label sets the ceiling. Fourth, meet with a qualified tax professional to evaluate whether capital losses elsewhere can offset gains before you trigger sales. Fifth, document transaction fees and storage costs because they can matter to your net math and cost basis support. Finally, establish a dedicated tax reserve account so you do not spend profits that already belong to a future tax payment. Remember the collectible ceiling and the potential additional layers because the difference between paper gains and net gains is your lifestyle quality for your objectives or your retirement. Review Schedule D inputs and supporting statements, and confirm they match the records your broker or dealer will report. Are you prepared to run this math before you sell, like, subscribe, share, and comment on your current withholding strategy for 2026? This content is for educational purposes only. It is not tax advice. Regulations change. Consult a qualified professional for your situation. If you want, I can draft a tight comparison between physical bullion, mining stocks, and futures-based products so you see the net math clearly.